Imagine if you could step into a time machine and buy high-quality assets at the exact prices they were trading at 5 years ago. That is not a fantasy, but a very real opportunity available in the stock market right now for those who are paying attention. While the broader S&P 500 has continued to make new highs, a specific group of blue-chip companies has been left behind. I have identified 5 massive companies that are currently trading at or below their 2020 price levels here in late 2025. These are not failing businesses on the verge of bankruptcy, but profitable giants that Wall Street has temporarily hated. If you missed a chance to buy these iconic brands during the pandemic crash, you are essentially getting a second chance right now. First on our list is PayPal Holdings, which has arguably been the most hated stock in the entire market for the last few years. If you look at the chart, PayPal is trading at levels we have not seen since roughly 2017, completely wiping out the pandemic gains. During the 2021 euphoria, this stock was trading near $300 per share as online shopping exploded globally. Today, you can pick up shares for a fraction of that peak price, despite the business being fundamentally larger and more profitable. The narrative on Wall Street is that competition from Apple Pay and Google is going to slowly kill PayPal's business model. However, the company is still a free cash flow machine generating billions of dollars a year that they're using to buy back stock. By aggressively reducing the share count, they are increasing the earnings per share for every single investor who holds onto the stock. The market is currently pricing PayPal with a multiple that looks more like a boring utility company than a global fintech leader. If the company simply maintains its current level of profitability, the returns from here could be substantial due to valuation expansion. Moving on to the second stock, we have a consumer discretionary giant that has been an American icon for over 40 years. Nike is currently trading at price levels that look very similar to where it was during the initial pandemic panic of 2020. This company has faced a perfect storm of headwinds, including high inventory levels and slowing sales in the Chinese market. Newer brands like Hoka and On Running have been taking market share in the running shoe category, causing investors to panic. However, we have seen this story play out with Nike many times before, and they always seem to bounce back stronger. The brand equity of Nike is virtually unmatched, with some of the most recognizable and marketable athletes on the planet. When a company with this kind of economic moat falls by 40% from its highs, it usually represents a buying opportunity. They are currently in the middle of a massive restructuring plan to cut costs and improve their profit margins over the next 2 years. The dividend yield on Nike has also pushed up to levels we rarely see, giving you a nice incentive to wait for the turnaround. Our third pick is the Walt Disney Company, perhaps the most famous entertainment brand in the world, yet the stock has struggled. Disney has been trading in a range recently that is dangerously close to its COVID lows from March 2020. Think about that. The market is valuing Disney today the same as it did when its theme parks were completely shut down globally. This disconnect is due to fears about the decline of cable television and the high cost of building their streaming business. However, the streaming segment has finally reached an inflection point where it is turning profitable after losing billions. The theme parks and experiences division continues to be a cash cow, generating massive operating income despite economic worries. The valuation today implies that their intellectual property, from Marvel to Star Wars, is worth significantly less than it was years ago. If you believe that families will still visit Disney World and watch Disney movies in 2030, this entry point is very attractive. Now, let's switch gears to the healthcare sector for our fourth undervalued pick, which is a massive income play for your portfolio. Pfizer is currently trading at levels that are actually lower than where it was for much of 2020, which is mind-boggling. After a massive boom from their COVID vaccine revenue, the stock suffered a brutal hangover as those sales naturally evaporated. Investors have completely abandoned the stock, leaving it trading at a low single-digit price-to-earnings ratio. However, this sell-off ignores a massive pipeline of new drugs and the strategic acquisitions they have made with their cash pile. Pfizer used a pandemic windfall to buy companies like Seagen, positioning them as a leader in cancer therapies for the next decade. Because the share price has fallen so much, the dividend yield has skyrocketed to a very enticing level for income investors. You are essentially getting paid a high yield to wait for the market to realize that the company is not going out of business. For a conservative investor looking for income and value, it is hard to find a better deal in the current market environment. Finally, the fifth stock is a favorite among dividend investors, but has been hammered by rising interest rates recently. Realty Income, known as the monthly dividend company, has been trading near price levels we saw during the 2020 crash. As a real estate investment trust, their business model involves owning thousands of retail properties and collecting rent. When interest rates rose rapidly, investors sold off REITs because they compete with bonds, pushing Realty Income's price down. However, their underlying business remains rock solid with high occupancy rates and consistent rent collection from major tenants. They primarily rent to recession-resistant businesses like grocery stores, convenience stores, and pharmacies that pay rent in all climates. The market has priced the stock as if rates will stay high forever, but as rates eventually stabilize, the stock should soar. You are getting a yield that is historically high for this company, backed by a portfolio of over 15,000 properties. The beauty of Realty Income is the monthly compounding effect, which accelerates your wealth building if you reinvest the dividends. If you are a long-term investor, you should view these lower prices as a gift that allows you to lock in a higher yield on cost. So, we have 5 distinct companies: PayPal, Nike, Disney, Pfizer, and Realty Income, all trading at depressed valuations. The common theme across all of them is that the market sentiment is currently terrible, while the businesses remain profitable. Investing when the news headlines are negative is psychologically difficult, but it is historically the most profitable way to invest. If you were to build a portfolio around these 5 names today, you would be creating a highly diversified basket of value stocks. You have exposure to fintech, consumer discretionary, entertainment, healthcare, and real estate all in one deeper value strategy. A reasonable allocation might be to put equal weight into each of these 5, or perhaps tilt more towards the ones you understand best. Remember that value investing requires patience. These stocks might not double next week, but they have coiled potential. The goal is to buy assets for 50 cents on the dollar, and then simply wait for the market to agree with your assessment. In 2025, with the broader market looking expensive, finding these pockets of value is your best defense against a potential correction. You do not need to take massive risks on speculative startups to build wealth. You just need to buy great companies at fair prices. These 5 stocks offer a rare combination of safety, income, and capital appreciation potential that is hard to find elsewhere. I want to hear from you in the comments. Which of these 5 beaten down giants do you think has the most potential right now? Are you adding shares of Disney or Nike while everyone else is selling? Or do you think there is more pain to come? Make sure you're subscribed to the channel so you do not miss our next deep dive into high-yield dividend opportunities. Take control of your portfolio today. Do your own due diligence, and I will see you in the next video.